Hey everybody, I'm Logan Alec. I'm a CPA. I own Choice Tax Relief. We help folks who owe significant back taxes to the IRS or their state. And today we're talking about non-liable spouses. What is a non-liable spouse? A non-liable spouse is a spouse who's married to somebody who has tax debt. But the non-liable spouse does not have tax debt. Okay? So we have a lot of clients who come to us who racked up a lot of tax debt before they were married. When they were single, and now they got married. So our client is on the hook for that tax debt, but their spouse is not. We also have folks who incurred tax debt while they were married, but they always filed separately from their spouse to kind of separate their spouse from the situation. So their spouse doesn't have any tax debt, but they do. Okay, so both of those situations can create something called a non-liable spouse, which is a spouse who is married to somebody who has tax debt, but they themselves, a non-liable spouse, do not have tax debt. And that's, I think, what Sean Christopher is getting at with his question today. If you file jointly, do you have to include your spouse on your form? Now, he made this comment on my video about the offer and compromise guidelines and formula. So I assume Sean, when you're referring to your form, you're referring to the offer and compromise forms. And the typical offer and compromise forms is the form 656, which is the actual offer, right? The contract that you're signing and submitting and hoping the IRS agrees to. And there's also, oh, I did not put that on the screen. Sorry, folks. So there's a form 656, right, called offer and compromise. But where you do your financial analysis for the offer and compromise, that's on a different form that you submit along with the form 656. That's on the form 433A OIC. Okay, and it's the calculations on the form 433A OIC that I go over in the video that Sean commented on. You could see it, the thumbnail down there in the bottom right, offer and compromise formula and all that. Okay, so Sean, let me just tell you, on the form 656, let's go down here. Oh, come on. Let me pause it and find it again. On your form 56, check it out. Check it out down here. Only if it's a joint offer, right, for joint tax debt, do you put your spouse's name on there, okay? If your spouse is not liable for the debt, then the offer is not being made on behalf of the spouse, right? Does that make sense? Right? The offer and compromise is an offer from a taxpayer or taxpayers with joint debt to the government to settle their tax debt, okay? There's no reason why a non-liable spouse would make an offer to the government to settle tax debt because they don't have any tax debt. And Sean, I'm assuming here, and maybe I jumped the gun here, I'm assuming here that your spouse is not liable for the debt, right? You asked if you file jointly, do you have to include your spouse on your OIC form? Now, if it's joint tax debt, right? Typically, spouses want to make that offer together to the government, and so yes, they would be on this line since it's their debt, just as much as it's your debt, because that's what happens when you file a joint tax return. Both spouses become jointly and severally liable for the debt. Doesn't matter who earned the income or who didn't get enough withheld; they're both on the hook, equally on the hook for it. Okay. Now, it is possible to have a joint tax debt, and we see this often in the context of divorced spouses, where now the spouses are divorced. They both have that joint tax debt from when they were married and they filed jointly, but we're only representing one of those spouses, right? So they could submit an offer just with respect to them. The liability would be separated. So oftentimes we have to request that the IRS mirror the liability, which essentially takes it from a joint collections case into two separate kind of collection cases, one for each spouse. And, just one spouse can submit an offer and compromise just to settle the debt with respect to themselves, right? And in that case, they would not put the other spouse or the ex-spouse here. they would only put themselves there. Hope that makes sense. Now, the second form that we talked about, and let me pause it and go back up to it, is the 433 AOIC. Okay, and this is a collection information statement, like all the 433s. Basically, this is your full financial disclosure to the IRS about your financial situation. And if you live with your spouse, then your spouse is a part of your household, and you would have to include, well, let me back up. They would affect how you fill out this form, even if they're not liable. Even if they're not liable. You would still, even if they're not liable, you would still put them, their information down here, provide information about your spouse. You would say, you know, you're married, right? If married, date of marriage. But the question is, when you're doing this financial disclosure to the IRS, should you include, you know, do you have to include your spouse's income in the financial analysis, right? And for that, we go to section 5.8.5.20 the Internal Revenue Code. 5.8.5 section of the IRM has to do with the financial analysis of a taxpayer with respect to the IRS offer and compromise program. Okay, and as you know, if you watch my offer and compromise videos, your offer and compromise amount is also known as a reasonable collection potential, and it's the combination of your equity and assets as calculated by IRS math, plus your net disposable monthly income calculated according to IRS numbers and capped to IRS standards, multiplied by a future income multiplier, typically 12, but it could be 24, depending on the kind of offer you're submitting, lump sum or periodic payment. Okay, so the question is, well, do I include my spouse's income in that monthly disposable income figure, right? You probably don't want to, because that means your monthly disposable income would be higher if you have to include your spouse's as well. And so for this, we look at this section here in the IRM, 5.8.5.20, future income. Okay. Let's see. It talks about spouses. Where? Hold on. Sorry. They used to mention it up there. Now they mention it in this shared expenses, 5.8.5.24. As of a few years ago, I guess. I don't know. When I learned all this stuff, it was all in my head, the old reference numbers, but they change things, you know, every now and then. Anyway, check it out. Check out this paragraph right here. Generally, the assets and income of a not liable person are excluded from the computation of the taxpayer's ability to pay. Okay? So, if your spouse is a not liable person, generally, their assets and income are excluded. Okay? Now, there is issues in community property states, okay, where theoretically the IRS could go after some of the non-liable spouses' stuff, basically. Okay. They often don't push on that, but they can. But in the typical scenario, here's what would happen. Okay, typical scenario is, let me go back to the 433 AOIC. I'm not putting the non-liable spouse's income here. Okay, I'm not putting it there. Because on the basis of the IRM, generally the assets and income of a non-liable person are excluded from the computation of taxpayers' ability to pay, even if you live in a community property state. For taxpayers who live in a community property state, I'm not including the spouse's stuff on this form. I'm going to let the IRS go and make the argument to me, to us, that we need to include the spouse's stuff, but I'm not going to do their work for them. Okay, I'm going to put the onus on them to notice it's a community property state and let them tell us, okay, we got to talk about the spouse's stuff here since it's community property. I'm not going to volunteer that information to the IRS. That's our policy here at Choice Tax, because we've learned that we got to be as aggressive as possible with this stuff, especially with OICs, since there's so much pushback, right? Even good offers are rejected and you have to take it to appeals, right? It's a long and daunting process. But what I'm doing, and it's our policy at Choice Tax Relief, is to not put the non-liable spouse's income here. However, Um, let's see, under the expenses, right, section 7 here, there is generally kind of a bifurcation of the household expenses, right? If you have two people, two spouses contributing to those expenses. And I think that's kind of why they moved all this down to the shared expenses section, for that reason. Right. So, if your mortgage, right, doesn't exceed the standard for housing for your area and your family size, if it was just a single taxpayer, who doesn't have a non-liable spouse, then I would just we'd put their entire housing expense here on line 40, right? But because there's a non-liable spouse, and we know that the offer examiner, the offer specialist, is going to do this anyway, the guideline I just tell my staff and myself when I'm reviewing this stuff is look at this here, because this is what the IRS is going to do. Okay. Yeah. Right. The offer examiner, offer specialist should secure sufficient information concerning the non-liable spouse's assets and income to determine the taxpayer's proportionate share of the total household income and expenses. Right. Review the entire household's information, determine the actual household income, right, in total, determine what percentage of the total household income the taxpayer contributes, right, and determine allowable expense amounts using the rules in this chapter and financial analysis handbook, determine which expenses the taxpayer and others have agreed to share, blah, 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 right, apply the taxpayer's percentage of income to the shared expenses, okay, and verify that they actually contribute this amount, right? So basically, look, if you make, let's say your mortgage is like $5,000 a month, okay, and that's below the standard for your area and your family size. But you make $1,000 a month, and your spouse makes $9,000 a month. What the offer examiner or offer specialist is probably going to do is they're probably going to say, all right, you pay a $5,000 mortgage, and we're not going to let you put $5,000 on this line here. We're going to say that because you make 10% of the household income, 1,000 over 10,000, that you could only put $500 there, right? Because we're going to assume that your spouse, who makes 90% of the income for the household, is paying the other $4,500, right? Now, you can fight and you can prove and you can show otherwise, right? And they're going to probably want even back more bank statements than the typical 3 months, right? So they can make sure you're not just playing games here for the past few months. But that's typically what's going to happen, right? So while the non-liable spouse's income doesn't necessarily, or it's our policy not to include it as income, right? Either here in section 2 or in the business section either. We typically can't get away with not prorating shared household expenses based on the house's respective share of income, or if they have a long-standing agreement about how they're sharing expenses and that's more advantageous to their case, we could use and present that. Okay. And gee, Sean, I really hope this is what you were asking and I didn't go down a rabbit trail here. Basically, Sean, if you're watching this video, leave a comment below. Let me know if I actually answered your question. If your question was something totally different, comment and I'll make another video to answer that. So, folks, thank you so much for watching. I have more tax relief videos here on the left-hand side of the screen about offers and compromise. If you'd like a free consultation, reach out to us at Choice Tax Relief. You can call 866-8000-TAX or visit choicetaxrelief.com. There should be a button floating around here somewhere. Go there, fill out the form on our homepage, and we'll talk to you soon. All right, everybody. Thanks so much for watching. See you in the next video. Bye-bye.